Hello, everyone. A very good afternoon to all present here. I, Nupur Vyas, a senior associate in India Juris, hereby welcome all the speakers and attendees on behalf of India Juris. Here we are in the series of webinar, and today's topic is setting up angel fund in Gift City, talking about the compliances as well as taxation. India Juris is a leading law firm providing full legal services pan-India as well as in the global market. And we are ranked number 1 in PVC transactions as per Venture Intelligence list. We have multiple offices across India in Delhi, Gurgaon, Mumbai, Bangalore, and Gift City, Gujarat. We are providing legal services in private equity, venture capitalists, startup investment transactions, doing civil litigation, corporate commercial litigation, as well as advising the clients and helping them in setting up funds and the allied services. In today's webinar, we have various attendees, which are funds, professionals, consultants, advisors from across the globe, like London, US, Delhi, Mumbai, Bangalore, Hyderabad, Gujarat, and many more places. We are here to welcome the speakers and ask them to enlighten our attendees. So today's speakers are, first, there Mr. Venkatesh Prabhu. He's a director at Midcoin Credential. He's a qualified chartered accountant from ICAI and cost accountant from ICWI, having more than 12 years of experience in trustee business. He's a key managerial personnel in setting up the entire trusteeship business from scratch and achieve exemplary recognition in the trustee industry. I welcome Venkatesh Prabhu. Second speaker is Mr. Ishank Shah. He's a partner at Banshi Jain and Associates and heads the startup transaction and fund practice at the firm. He's a chartered accountant, chartered financial analyst, and a registered valuer. He advises clients in domains which include e-commerce, blockchain, cryptocurrency, and FMCG on financial, tax, and regulatory matters. I welcome Ishank. Third speaker is Ms. Shivasangri Chinnappa, heading Startup and Transaction Advisory Vertical in Banshi Jain and Associates. She is a qualified CA and registered valuer for securities or financial assets category. Her practice area is due diligence, valuations, transaction structuring and support, cross-border transaction, corporate restructuring, and FEMA. I welcome Shivasangri Chinnappa. And the fourth speaker is Advocate Samir Rastogi. He is a managing partner of India Juris and having more than 2 decades of experience in advising and representing the clients across the globe in various sectors like corporate law, foreign exchange law, foreign direct investment, joint ventures, foreign collaborations, mergers and acquisition, restructuring, capital market, fund structuring, etc. I welcome Mr. Samir Rastogi. Now I request Samirji to proceed with the webinar and welcome our speakers.
Thank you, Nupur. It's a pleasure to have this session of the webinar on setting up angel funds. So friend, we will go very fast on the subject, on the presentations, and we will be having presentation on setting up angel fund in Gift City. We'll have a session on compliances, we'll have a session on taxation, and thereafter we take up questions which are coming up to the audience, and we already have received so many questions, so I think we'll be throwing a lot of questions to our esteemed speaker Venkatesh and Ishank on taxation and compliances, because Gift City angel funds are new and many things are coming up on a daily basis, so we'll have a lot of things to note about. So friends, you know, in India we are passing through a very good times, I would say, that India having a very good geopolitical situation in the world, and Indian diaspora spread across the world, and everybody is bullish on Indian market and they want to participate in the growth of India. So it's a high time when Indian diaspora spread across the world, they come back and invest in India, and Gift City is one of the solutions, which is wherein they can come and participate in the angel funds in Gift City, and there are a lot of relaxations which we'll hear from during this particular session. So I'll take you through the setting up angel fund in Gift City, and thereafter we have taxation and compliances. So let's move on fast on that. So we'll take up the questions at the end of the all the presentations are over. By the time, please put in your questions in the chat boxes. So friends, setting up angel fund in Gift City. Gift City, it's a from last 1.5 year, it has come in a lot of limelight, and it is people are exploring it. Every month we are receiving a lot of requests from India and across the globe inquiring about the Gift City, how to set up the fund or angel fund and all those things. So this session is dedicated to angel fund. So we'll move fast on this. So friends, the angel fund, the main regulation which is regulating all the funds in Gift City is FME regulation, which was in April 2022. And this is the mother regulation where you'll find each and everything about the funds, whether it's angel fund or any other category fund. So this particular regulation basically talks about the investment manager, which is FME. So, and other is the kind of funds, schemes. The funds and schemes are one and the same thing. So venture capital scheme, you see, and other services, what can be done in the Gift City. So first part is fund management entity. So three type of fund management entities are possible in Gift City. One is authorized, registered, non-retail, and the third is retail. And what kind of funds you can launch? It is venture capital funds. You can do restricted schemes and other, so various types of funds. So this we have dedicated to angel fund. So we restrict ourselves to the angel fund at the moment. So when you are going to set up a fund in Gift City, first of all, you have to set up an investment manager entity, which is authorized FME is the basic one. So what is angel fund? Angel fund is a subcategory of venture capital scheme. It is as specified under Part A of the Chapter 3 of the FME regulations. You can download the latest version of the FME regulation from the IFSC website, and you get under Chapter 3, you will get all details about the angel fund. And from where that raises fund from the angel investors that invest in angel fund FME. So after the FME regulations, there was a circular issued by the IFSC which talks about angel funds. So the FME regulation and that circular both together forms the whole system, whole regulatory system of the angel funds in Gift City. So what's an angel investor? An angel investor can be an individual also. It can be a company also. So what's the legal structure of the angel fund in Gift City? So it's a typical structure. It is globally, it is the same. So you have in the mid, you have the fund, which is formed in by way of a trust. You have an asset manager on the left side, which provides management services and charges fee to the fund. And you have a trustee, so which provides a trusteeship services to the fund. And where this can invest, it can invest in early stage venture capital undertaking and in the other angel fund set up in IFSC, India or foreign. So this is the basic structure of an angel fund which is there. So why we are talking about angel fund? Because we receive a lot of individuals who are running networks and syndicates in India and globally. They have a network of, let's say, 20-30 angel investors, or some have 100, some have 200, good amount of angel investors, and they want to syndicate a deal and invest in India. So angel fund is the best solution for them. You set up an angel fund. For each deal, there is a separate set of investors. So you do get a set of separate investors, do a deal, and then it goes on. So it gives you a class for each separate investment. In case there are many people who syndicate, who are running networks as syndicate, they come and they want to set up funds, but they face a difficulty of net worth. So I'll talk about that particular, what is the problem with the people who are trying to set up angel fund but could not do because of financial crunch. How to solve that, we'll see on the next slides. So this is a typical structure on a fund side. So when you are setting up a fund, what are the main documentation which goes on, which is private placement memorandum? That is a must. That has to be made. A trust deed which a fund enters into with the trusteeship services, which uh, Venkatesh Prabhu is representing a trusteeship company. A contribution agreement, whatever investors you bring in, they have to sign this fund, the agreement with the fund. So that is contribution agreement. Then investment management agreement. This is the agreement between the fund management entity and the fund. So what kind of work they will be doing, what expenses they will be charging, all those is written in that. And trustee agreement. The trustee agreement is between trustee and the fund. And the trust deed at number 2 is the trust deed, which is the document of the fund, which you call a fund. This is the document, trust deed of the trust with the which is incorporated. So these are the main documents. Whenever you are setting a fund, you will come across this. So now, as I said, that first you have to establish a FME before launching a fund in Gift City. So now there are, as I told you, there are 3 type of FME. The basic one is authorized FME, so I have taken that. That is more than enough for running an angel fund. But if you want to, there are other restricted and non-detailed, you can form those FME also. But for them, financial requirement, other requirements are higher. They may also launch the angel fund, but they are not the threshold for launching an angel fund. For launching an angel fund, this one is the best. In future, if you want to launch any other fund other than angel fund, it is always, you can always upgrade this FME to other higher FMEs. So basically, to start an angel fund, this is the best. So now the type of the FME, it is authorized for required for an angel fund. You can form a company, LLP or a branch. In any way, you can form an asset manager in Gift City. So now here is the catch. Many people who want to start the fund, they are short of creating net worth. As you say, for this, the net worth is required $75,000. So you need money. If you set up a company there as a FME, you need a 75,000 there, and you have to show there. So now this is the place where most of the people, their programs are delayed, and they keep on, try to fix up this particular net worth. The other thing is, if you already have a company in India or anywhere in the world, and that is regulated entity, so you simply open a branch, and that the net worth of that will be counted there. So that is the benefit if you already have a branch in India. If you already have a company in India, like suppose you are already running a fund in India, so your asset manager in India would qualify there, and their branch can be taken as an FME. So you cut short lot of requirements. Other thing, what I say, when somebody wants to launch an angel fund in Gift City, and if you don't want to have an FME, so you can combine or collaborate with the existing FMEs there in the Gift City, and they can launch your fund. So that can also be explored. So these are various modalities we can take offline if there is such requirement. So you can consider that using FME of someone for launching your fund. So as I said, for authorized FME, minimum worth is required is $75,000. So when you launch a fund, obviously skin in the game is required. And what is skin in the game? The asset manager of the FME has to put 2.5% of the corpus or $20,000, whichever is lower. That much amount is required. So it has to be an ongoing basis, and within 45 days you have to meet out this. But here is a catch. If you don't want to contribute, you take a more than three-fourths of the investors' consent, then these contribution can be waived off. So it totally depends upon you whether if you can get it, then so many of the FMEs have done that. You can also, if anyone who wish to set up, they can do that. So as per the regulation, minimum employee, you need to have a physical office in Gift City when you are putting an FME, and one person is principal officer is required over there. So launch of a scheme means launch of funds. So the FME which you make, it can launch as many funds as it want. So, but here it is a green channel. Without the approval, you just simply file your PPM with the authority, and you can immediately launch it. This is the provision, but still they will look at it before allowing you to launch the fund. Minimum experience. So in other higher categories of FME, in higher categories of FME, you need people of different experiences, which is provided in the law. But here it says relevant. So you anybody who is a relevant experience, you can put them as in the FME. So this is more about authorized FME which you want to set up for launching your angel. So now we are on the angel fund side. So when you are launching an angel fund, what is it, how it can be done, what are the characteristics? So we will go fast on that. So when you establish an angel fund, where it can invest, so what investments it can do. So when it can invest in early stage venture capital undertakings. So what is this? The age of that particular undertaking or a company should be less than or equal to 10 years. The annual turnover should be less than $20 million, and it should not be promoted or sponsored related to an industrial group having turnover more than $50 million. So this is the criteria where angel fund can invest. So we see that at the moment in Gift City, there are two angel funds which are registered and very active, doing deals up and up very frequently, and both of them are our clients, are servicing, are working with us. So if you analyze, angel funds are mostly investing in very innovative startups, and most of the startups would qualify these criteria. Where else it can invest? It can invest in other angel fund. Other angel fund, it is registered in IFSC or India or any foreign. So there also it can invest. And it shall not invest in FME or a company connected to investing investors. For example, if you are in angel fund, you have launched, you are investing in an X startup or a company, and in that you have got 10 set of investors. So now so then you will not be able to invest in a company which is connected to these 10 investors. So that is what it. So if the investor is an individual, then there is a provision, and if the investor is corporate, then there is a provision. So means any company where they hold more than 15% of the holding voting right, so in that kind of company you cannot invest. So this is the basic of where an angel fund can invest and what you should look at before structuring your fund in Gift City. So number of investors permitted, how many investors you can have in angel fund. So per portfolio, maximum 200 investors can be there per portfolio. Suppose if you have 100 of startups you are investing, so each scheme, each startup you can have maximum 200 of investors. So what is the minimum investor? So whenever you onboard an investor in the fund, so minimum commitment they have to give $40,000 over a period of 5 years. For an accredited investors, there is no minimum limit. But definition of accredited investors is yet to be defined by the regulator. So maximum investment by the fund. So a fund, so what maximum investment this angel fund can do? So the maximum limit this fund can invest is $1.5 million per portfolio. So per startup, per company where you want to invest, it would be 1.5 million. And what can be the corpus of this angel fund? This is 1 million minimum, and maximum 200 million can be the corpus of the startup. When we say corpus, means 200 million means in all, let's say you are investing in 100 startups. So the total sum you invest, that would be the corpus, and it should not be more than 200 million. So it's a close-ended scheme, and the tenure provided is 3 year plus extension with 2 years. So this is the basic of the angel fund when you are setting it. So when I just told that you can the maximum amount you can invest is $1.5 million. So, but there is a provision you can invest subsequently in the same startup or the company. Then it can exceed more than 1.5 million. And but there is a regulation, means even if when you invest subsequently, it should satisfy the criteria which I have just mentioned earlier of early stage undertaking, except turnover. Turnover can go higher, but rest of the thing it should satisfy, like it should be below 10 years and other things. One other thing you have to see that only previous round angel investor can participate in next round. For example, you have invested in one company and 10 set of investors have invested in that. So now the fund wants to invest in a second round, then only those 10 investors only can invest in the next round. It is quite different from what we have in SEBI in India, where the angel fund can have different set of investors also in second round. But here you have the same investors. And the third is the post-issue beneficial interest should be the same as pre-issue of those participating investors. So here it is bit technical and calculative. So you have to see that when you are doing a subsequent investment through angel investment. So overall exposure of a fund in a particular early stage company or a company shall not exceed 50% of the total investment made by the fund in the startup, or 30 million, whichever is low. So all these criteria you have to see when the funds are investing, or what kind of things you are going to do. So leverage is not allowed for angel funds. So custodian, if asset under management is above $70 million, prior investor coverage of each startup or each company wherever you are investing, you would require prior consent from the participating investors. So you would send up a consent term sheet to them and they will agree, and then you invest in them. So this was a quick snapshot on the fund manager which you will set up for launching an angel fund, and the characteristics of the angel fund which will be launched by your FME. There is no rocket science in launching an angel fund. Only hand holding is required. Otherwise, it's very simple. You can look at from the regulations and everything. You can do it yourself, DIY. So this is the quick process which I have just mentioned. In GIFT City, there are two regulators. One is SEZ. It is basically a financial SEZ, and other is IFSCA, International Financial Service Center Authority, which is equivalent to SEBI in India. In India, the funds are regulated by SEBI. In GIFT IFSC, the funds are regulated by IFSC. So you have to take approval of both the regulators, SEZ and IFSC. So SEZ Development Commissioner will give you the approval for setting up an entity, to getting an office, registering there, and IFSC will give you from the fund regulation point of perspective. So first you apply to the SEZ, they give approval. You apply to the IFSCA, they will give approval, and in last you get final approval as commencement of business. You have to do your GST registration. You have to do your export import registration, that is compulsory, and thereafter you are ready and get to go. GST is zero, but we have to do nil filing in GIFT City for that. So friends, this was all about setting up and launching an angel fund in GIFT City at a very snapshot level, and we'll take more queries later on at the end of the seminar, of this webinar. So with this, I will invite now Ishank for Mr. Ishank Shah for on the taxation aspect of the angel fund. And here, before going to that, Ishank, I think on taxation we have questions coming around on three aspects, whereas one is the taxation of the FME, which is whatever the income FME is having, what would happen to that. Other aspect is the taxation on the fund, whatever fund is earning, what is happening to that. And third part is the investor. So whenever he gets the money, what happens to that? So I think, friends, we are going to get a lot insight from the Ishan team, Banshi Jain team on this. Over to Ishan. Thank you.
Thank you, Samir ji. Thanks, Nupur. Thank you to the India Juris team for putting all of this together. And good afternoon to all the participants and listeners. So I think in terms of what Samir ji was just elaborating, GIFT as a regime is fast evolving and developing. There is a lot of interest both from resident investors as well as non-resident investors in investing through the GIFT City. There is also a lot of gap of information and understanding which is being today filled up quickly, which is that Indians can also invest in overseas entities through or startups through GIFT City, right? So what is typically today being restricted to non-residents using the GIFT structure to come to India, there is a reverse side also, which is also there, which is the Indians could invest in overseas startups through the GIFT City vehicles, through use of LRS and ODI routes, and maybe another day for explaining on how that works. But that's something that is happening. I also have my colleague Shiv Shankari. She also sort of heads the practice and there's a lot of understanding on the angel funds and within GIFT City space. And I think, Shankari, if you can go right to the first slide. which is, and therefore to Samirji's question, and this is, and to Samirji's question, firstly, we'll clear that the first question and the easiest one to clear is whether the fund shall be subject to tax in GIFT City. So the answer to that is no. The fund is pretty much a pass-through vehicle, and it pretty much would earn capital gains income plus some bit of dividend income or coupon in nature, depending upon types of securities that it will subscribe to, and earn therefore that income on a pass-through basis, push it back to the investors. If for any reason the funds earn income in the nature of PGVP, which is profit and gains from business or profession, which is very less likely or almost not a negligible case, almost a negligible case, then that would be taxed at the fund level and distributed post-tax to the investors. But other than that, all incomes are passed through by the fund directly to the investors. The funds provide an annual statement of income that they, or losses both, that they have passed through back to their unit holders. So a statement of that effect is provided in Form 64C to all unit holders or contributors of the fund, which is what you typically refer to them as, or investors. And it's done on an annual basis to them. The fund, however, does a withholding tax obligation at the time of distribution, right? So before we get into the details of that, I think Shankri, if you'd like to briefly touch upon the type of structures, and then this was something that Samirji is pretty much covered, but maybe another 1 minute from our end, and we could go to the next slide. Shankri, you want to go ahead and take this?
Yeah, I'll take this one. So before we get into the details of what is the tax implication both for the investors as well as for the fund, let's have a quick look on what are the schemes that can be launched in the GIFT City. So basically, any fund management entity which have a license either through authorized or retail or non-retail can have launch 3 different type of schemes, which is venture capital scheme, restricted scheme, and retail scheme. When I say venture capital scheme, by the name insists, this is intended for investing in venture capital undertaking. Mr. Samirji already have explained what are the criteria that needs to be captured. Angel fund, our core topic for today, is also covered under venture capital scheme. Venture capital scheme is similar to what is called category 1 AIF in under SEBI regulations. And from an income tax perspective also, it all falls under category 1 AIF. And in terms of a restricted scheme can launch a different investment strategy. Depending upon the investment strategy, it can either fall under category 1, 2, or 3. Say, for example, a fund which have an investment strategy of complex trading strategies falls under category 3, and one which have an early stage undertaking falls under category 1, and the residual falls under category 2. And the last one, retail, it's similar to our mutual funds. That is intended for the retail investors, and there is no restriction on the number of investors that can invest. Who is eligible to launch a scheme? In terms of venture capital scheme, any fund management entity having authorized registered FME or non-registered registered non-retail can launch the scheme. There is no restriction, but the fund which is intended to do only angel fund, as Mr. Samirji rightly said, that is authorized FME is more than enough for you to run only the angel fund. In case of restricted scheme, then a registered FME and a registered FME non-retail can launch. And in terms of retail, registered FME retail license holder can launch the scheme. So this is a simple structure on angel fund. Angel fund, as Mr. Ishan clearly clarifies, you can raise investment both from residents as well as from a non-resident. But there are small differences with respect to both the categories. If the fund intend to raise investment from resident, then the fund can only invest in overseas investee company. Angel fund, it's a scheme based, it's not like a blind pool. So each scheme, if the scheme is invested for, intended for the overseas investment company, then you can raise an investment. Since same angel fund will invest both in overseas as well as a domestic company, you should have an operational segregation and how you differentiate the money received from resident investors or non-resident. This is just to ensure resident investors' money is not invested back in India, which is typically falling under a round-tripping category, which is not allowed under FEMA regulations. So if you are raising an investment, you can invest only in the overseas company. Tax implication in case of residents we will first see in a different phases of the fund. It's either in the entry route, income distribution, and exit for the resident category. If the resident is investing in a gift fund, in case of resident individuals, they can use LRS, which is called Liberalized Remittance Scheme, which is allowed under RBI for them to utilize USD 250,000 per financial year for various remittance, which also includes investment in overseas. So investment in gift is also an allowed category. You can use LRS to invest in overseas. It falls under overseas portfolio investment. For the resident individuals, if you are using LRS, then there is a TCS applicable at the rate of 20%. This 20% started from the 1st October. Earlier, it was 5%. So for any investment, if you are making into gift, there is a TCS applicability and 20%. And this is applicable only for the resident individuals, since TCS is applicable only for the LRS scheme. To explain this little in details, for example, Mr. A, he wants to invest 10 lakhs into an angel fund. 20% of the 10 lakhs, 2 lakhs will be categorized as a TCS, and the bank will collect 2 lakhs from them. This 2 lakh is not an expenses. It's not a cost to the investor. It's a tax credit which can be claimed against his other tax liability at the time of filing the individual return. And this applicability is only for resident individuals. And in case of any other entity, could be unlisted entity or public companies or any LLP who wanted to invest in gift, there is no TCS applicability because LRS is not applicable for them. And during the tenure of the fund will distribute various income, which includes dividend, interest income. These are all taxable in the hands of resident investors at the applicable tax rate. Business income, which is typically taxed in the hands of fund, because category 1 fund is a pass-through fund. All income will be taxable in the hands of investor except for business income, and business income will be taxable in the hands of fund. In case of exit, capital gains will arise, and capital gains will be depending on the type of instrument and a period of holding. If the fund have invested in equity or a preference shares, or in overseas investment, it is generally called common stock or a preferred stock. These are considered as unlisted companies under income tax perspective. So period of holding has to be minimum of 2 years to fall under the long-term capital asset. So if the fund is holding for minimum 2 years, then any gains arising out of such asset will come under the long-term capital gain, and the tax liability is 20%. And in case of a debentures, which is typically CCDs or convertible note or a safe in terms of an overseas companies, falls under a debentures category, and the period of holding for typically has to be 3 years. So if the fund holds more than 3 years, then it is a long-term capital asset and it is taxable at a 20% rate. In case of a short-term capital gain, everything will be taxable at applicable rates, and only the period of holding differs.
So just before you just go to the previous slide, just to summarize what's happening is that the fund is a pass-through vehicle. The investors will be provided, like you were mentioning, annual statements of income that has been credited to them in the nature of what is short-term, what is long-term, vis-a-vis their investment portfolio. Typically in an angel fund, you have a deal-by-deal setup or a scheme-by-scheme setup. So you may have invested in 5 companies, which may have been 5 different schemes of the angel fund vehicle. And let's say 2 in those schemes have earned you some sort of return, which has been passed back by the fund. The fund will also tell you whether it's a short-term or a long-term gain and what has been the period of holding of the fund. And accordingly, as an individual investor, you are expected to disclose that in your ITR. There is also a specific schedule called Schedule PTI, pass-through income, in your tax returns, where you are expected to disclose this pass-through income earned, the nature of the income, the tax on that income. You obviously will get credit for the tax withheld by the fund. But the point here is the responsibility of paying tax is on the investor, typical to how you do it in mutual funds as well, where the units or the investors themselves pay tax. You will be paying tax yourselves. The fund will provide you the necessary information for you to be able to do that on an annual basis by 30th of June of the following year. So March 24, you should receive this information by 30th of June 2024, which helps typical individuals file their return by 31st of July or corporates to file their returns by 31st of October. So timelines are met and data is provided, and you are expected, the investors are expected to do the needful. Yes, Shankari, you could go ahead.
So fund structure in case of a non-resident. Like resident investment, there is no restriction in case of a non-resident investors. If the fund is receiving, GIFT fund is receiving money from non-resident investors, it can either invest in Indian companies or it can invest in overseas companies. If the GIFT fund raise investment from a non-resident and invest in overseas companies, then there is no tax implication here in India. Say for example, Mr. A from a USA, he has invested money in GIFT fund, and GIFT fund using the money invested by Mr. A has further invested in a company in Singapore. Any income arising out of that particular investment is not taxable here in India because it's not deemed to accrue or arise in India. So it will be taxable in the hands of Mr. A as per the US laws. As per Indian law, there is nothing taxable. Since the income is not taxable, any loss arising out of such investment, he cannot use to set off against any other income from the fund. And scenario 2, if the non-resident investment has been used for investing in Indian entities, then what will be the tax implication? And at the time of entry, like resident investors, there is no tax implication. There is no TCS applicability. It's a free to invest. There is no tax consideration for that. During the tenure of the fund, if any income is being distributed and a dividend income is taxable at a 10% rate and an interest income as applicable rate, and a business income, as I said earlier, it will be taxable in the hands of fund, and therefore it is not additionally taxable in the hands of investors. And an exit, again, it depends on the nature of instrument and the period of holding. In case of equity or preference, it is typically taxed at a 10% without any kind of benefits, which means without indexation benefit or without foreign currency benefit. The gain will be taxable at 10%. In case of debentures, again, the same rate, it is 10% without any further benefits. In case of a short-term capital gain, both for equity as well as for debentures, it is taxable at an applicable tax rate. But under section 194 LLB, any income distributed to the non-resident, there will be a withholding tax at the applicable rates, which means in case of long-term capital gain, 10% will be withheld, and in case of a short-term, applicable tax rate will be withheld, and only the tax withheld amount will be distributed to the investors.
Only the tax not withheld.
The net of tax withheld. Net of tax.
And again, just on the previous slide, the difference in tax rates, if you observe, for non-residents, capital gains tax rates are 10%. You would have observed in residents on unlisted securities is 20%, but for non-residents, it's 10%. So just by virtue of being non-residents, they also enjoy a preferential tax rate on capital gains at the time of exits, which is 10% versus the residents at 20%. So it's an arbitrage. But so be it. That's the difference between a residency and a non-residency from a ultimate capital gains tax point of view on a unlisted security.
So other benefits that are available to non-residents. If non-residents are investing only in IFSC, is there only income from IFSC, then there is no requirement of applying for the PAN, which means he need not have a PAN, and there is no requirement of income tax return filing also. Versus if non-resident directly invest in Indian companies, any investment over and above 1 lakh PAN will be required. PAN is a mandatory. So they have to apply for PAN, and there has to be regular filing of income tax return filing. These were exempted if they were routed through gift fund. And that's one of the tax incentives or a beneficial available to non-resident shareholders. But this benefit is available only, the only income if he gets is from income from IFSC, and the tax has been withheld as per the section 194 LB. And just a small example how it operates. Say, for example, there is an USD 40,000 of amount has been invested by non-resident, and this is at the exchange rate of 80. There is 32 lakhs of investment being invested in Indian companies. Assume after 2 years, or this is being shares, I'll assume after 2 years, there is an exit at 3x. So 32 lakhs have become 96 lakhs, and there's a capital gain of 64 lakhs. And in the capital gain, we also assume there is some carry that needs to be shared with the investment manager. Assuming the carry is at 10%, 6,40,000 carry payment needs to be made. So the net of carry, investor is getting a capital gain of 57,60,000. And withholding tax on this particular capital gain, being a long-term capital gain at 10%, along with a surcharge of 15% and a cess of 4%, which comes to an effective tax rate of 11.96%. On 57,60,000, it comes around 6.88 lakhs. So the amount will be distributed will be this total sale consideration, which is 96 lakhs, less there is a carry of 6,40,000, less there is a TDS withheld, which is a 6,88,000. So the net of these amount, which is coming approximately around 82.71 lakhs, that will get distributed to the non-resident shareholders. This get converted into the respective exchange rate, and the final amount will get distributed. So that's about the tax implication for the investors investing.
Shankari, if we can just go back on that. Also to mention on the tax treaty piece. So if the investors happen to be tax residents of countries with which India has a tax treaty, then they will be entitled to enjoy tax treaty credits with India, and therefore whatever tax has been withheld here in India can be claimed in their local country against the ultimate tax liability that they are required to pay. So that is the way in which they will need to account for the tax withholding which is happening in India. Shankari, we just want to add to this.
Yeah. So the tax which withheld, which is now 6.88 lakhs, depends on the tax treaty. If the foreign tax credit is available with the respect of the country, you can file a form foreign tax credit, which is different from in different countries. You can file that and take a credit. This amount is not a refundable amount, which means you can claim credit only against the tax liability of your foreign income. And this also depends on the tax treaty benefits available between the country. So you have to see from the non-resident perspective, they have to see from which country they are investing, whether there is any tax treaty available with India. If so, then they can take the credit. The credit again needs to be filed through a form in their respective country against the tax liability of that income. So moving on to the tax implication in case of fund management entity, the government has given the various tax incentives for the entities operating in IFSC GIFT cities. For the fund management entity, there is 100% tax holiday available for 10 consecutive years out of 15 years. The 15 years starts from the date of approval. So the moment you get the date of approval from IFSA, then you have a right to choose from which year you wanted to exercise. When you start exercising, the next 10 years, your tax, 100% tax will be exempted, tax holiday. In case if the company is, if it is operated under company structure, and you may have to see MAT applicability, or in case operating under LLP structure, you may have to see a AMT applicability. But this MAT and AMT, which is 9% or 18.5%, is not applicable if such entities opted for a new tax regime. The company structure, if the fund is operating under the company structure, if the fund management entity is operating under the company structure and they have opted for new tax regime, which is 22% tax, then the MAT is also being saved. and the income earned from the IFSC GIFT City, that is also completed exempted, which means you are 0% taxpayer in terms of income earned from gift fund. And similar provisions also available for GST for the management services that you are provided to the IFSC gift fund. There is no GST on the management fee. And any income which is earned by the FME, it is not taxable in their hand. It will be taxable in the hands of shareholders of the fund management entity at their applicable tax rate. Gujarat government is also has given lot of subsidies, which includes 100% reimbursement of employer PF contribution, and there is an electricity duty reimbursement, and there is 1% subsidy on power tariff, and there is certain lease rental subsidies also available. So both Gujarat government and Indian government has given up the various tax incentives for the entities operating under IFSC. And that's about tax implication of investors and fund management. Open for your queries.
Yeah, thanks, Shankari. And one last bit that we just want to sort of distinguish or differentiate and sort of again helps tax professionals understand GIFT City better is that from a tax point of view, the GIFT City entity is an Indian entity itself. It's an Indian tax resident. It is not an Indian FEMA resident, or an exchange control point of view. It's considered as an entity outside India, and therefore whatever money is wired is considered as money wired outside India, or money received as received outside India. So from an exchange control or a FEMA regulation standpoint, the special economic zone gives it the treatment of a non-resident transaction. But from an Indian tax ecosystem, it treats that entity as an Indian tax resident, but provides for a lot of these benefits or exemptions from the income as if it would be providing to any Indian entity, and the tax withholding and the pass-through status. All of these go through like an Indian AIF gets treated today here in India from a SEBI category 1, 2, 3 standpoint. So the differentiation is more from an exchange control standpoint rather than from a tax standpoint.
So thank you, Ishank. You can unshare the screen. It was really insightful on taxation, and there are a lot of queries which I also have, and I have received these queries prior to this start of webinar. So we will quickly finish up our presentation by Venkatesh, and then we'll take up all the queries which are coming up. So now, friends, I call Mr. Venkatesh Prabhu, and he has been now working for more than 100 funds. I don't know what all. He is master on this subject. So Venkatesh, please, I request you to please let us know about the compliances and what the angel funds are required, and how you are doing it for other angel funds. Thank you very much. Please, Venkatesh.
Yeah, you can see the screen, right?
Yeah, it's yeah, you can put on presentation mode. Yes.
Yeah. Just hold on. Yeah, thank you, Samirji. Thank you, Ishan, for the insightful subject. It was, in fact, for taxation also. I'm very sure that everybody was very keen on the taxation part, because that's how the pain point in getting to IFSCA. Thank you, Samirji, for arranging and hosting this. This was a very useful platform. Of course, I will just give you a brief background about who we are, and we'll take the conversation ahead. Yes, of course, I'll just give you a brief background. Mitcon Cadencia is a SEBI registered debenture trustee, and working for more than 100 funds right now, and more than 15 AIF in GIFT City. It's been
You can put on presentation mode.
and there's some problem.
function 5 key, I think.
Just hold on. Just a second, I'll just do it.
Let us continue. Let us, yes. Let's go.
I don't know, there's some issues.
No, okay, let us go. Let us move forward. Yes.
So, yes, so we are working for more than 100 funds right now. Have a team of more than 50 members internally and offices across 8 locations in India. I think there's some problem.
Yeah, you can go with that. Yes.
Yes, so of course, FME regulation has completely changed and came in 2022. Of course, Ishank and Samirji has already given a lot of insight about the transactions and how the structures have really worked. Angel fund, which is a bit similar to the domestic angel fund, comes under the venture capital scheme, and it is treated as a non-restricted, non-retail scheme under the IFSC Act. So this is a brief of various type of FME authorities, type of scheme, strategy-based investment, other fund management activities which is allowed in GIFT City right now. This is a typical structure which an AIF works around in the GIFT City. Yes, this is how the process works in GIFT City. Of course, just to give you a brief idea, first of all, it has to be in the form of a branch, or your LLP or private limited company is something which can be set up. You have to take a space in IFSC, go to SEZ and IFSC, get the approval, and subsequently launch multiple trust in this same FME entity. There is a challenge recently we have seen, just for people's insight here. The multiple scheme under the same trust is a challenge in GIFT City right now. So we are talking about a scheme not as a scheme of an angel fund, but a normal VC fund. So people are going ahead and doing a multiple trust structures, because SEZ is not recognizing scheme as a separate partition under the trust, how you have it in India entity right now. So people are going ahead with multiple trust structure only. This is just a brief background about what is an angel fund, and what, of course, the documents required are the standard one, which we have it in Indian and AIF as well. That's trust deed, IMA, PPM, contribution agreement. Who can become an angel investor? Of course, individual, venture capital scheme, fund set up in foreign jurisdiction. It has a green channel. The green channel means, you have a direct access. Once you have FME in place, it's a green channel. You can directly launch the fund and provide the details to FME. But yes, FME intention is to get some sort of approval from them as per the recent circular. Samirji has already given an insight about what exactly is the early stage venture capital undertaking corpus. So I will not be getting into those regulations again. Investment methodology and restricted investment. Of course, you have to take an express consent from each of your contributors. It has to be a closely netted segregated portfolio. So each scheme has to be a separate, each in a trust, each that your angel fund has to have a separate scheme for each of their portfolio, and it has to be bankruptcy remote and segregated portfolio. Cannot have more than 200 investors in each scheme. Of course, there is a lock-in of 1 year, no leverage allowed. Each investments cannot exceed more than $1,500,000. The main crux of the angel investors right now is the compliance part. There are a lot of untouched area in IFSCA, which is again a gray area, but still we have tried and captured as much as possible and as detailed as possible. But of course, there are a lot of gray areas which we want to give a disclaimer. One-time registration, in domestic, you have one-time registration like your KRAC, KYC. It's pretty much not clear in case of GIFT City, but we insist that you have to register with Financial Intelligence Unit, get a GIN number for as a global identification number. Investment into, of course, investment has to be done in a venture capital undertaking, which the definition is already defined. Whenever there's an onboarding client, PAN is not required or compulsory. That's why GIFT becomes a major happening destination for a client who want to pool in money rather than Mauritius and Singapore. Say GIFT is rapidly doing it. In case of PAN, of course, we insist, and it's advisable to get an equivalent tax identification number and an address proof, just like we do it in India. For non-individual, UBO is one of the factors. Of course, there are other information which you have to take it as a foreign entity. You should take it, but UBO is something which is very, very important, because looking at how the regulation is, they are looking at the IFSC and other authorities are looking at where the ultimate beneficiaries are residing, and hope it is not from the FATF gray list area or FATF banned area. So the investors or the FME has to be very particular and keep checking where their ultimate beneficiaries are into. Just like I said, each scheme has to be segregated and ring-fenced. You cannot have really a pool of investment like people are doing in domestic angel fund, where everybody is given everybody's share. We have seen such structure, but in an angel fund, each scheme has to be segregated, and scheme needs to be closed, units needs to be allotted. That's the most important criteria for an angel fund in GIFT City. Just like you have it in domestic fund, you have to intimate IFSC authorities within 10 days of it's like a term sheet which we do it in a domestic fund. It's a format which has been provided by the IFSC authorities, which needs to be done. One thing we would like to highlight, different from a domestic and a GIFT City, maybe it may be open to discussion. That's my personal interpretation. In GIFT City, each scheme should have equivalent or the skin in the game for each scheme and not the overall trust perspective. Whereas in domestic, the 2.5% criteria is for the entire fund, but in GIFT, it is for a particular scheme. So if you're launching one scheme, then each scheme should have an equivalent contribution. Of course, there are exemptions on those lines. SEBI has prescribed half-yearly reporting for the FME authorities because in IFSCA, it's not the fund which is getting registered, but it's the FME which is getting registered, and they have to report it to IFSC authorities within 21 days. That's how the regulations are. But recently, IFSC authorities has, without circular, there has been some changes. They have intimated about change in the reporting requirement and the timelines, which as per authorities is 21 days, where they've asked this within 10 days. Of course, you have to file your financials, income tax returns. Ishank has already given a lot of inputs on the income tax perspective. One more aspect which you have to be in, we have to comply in the IFSCA is the details of financial to be submitted to IFSC authorities every year. more things are going to come, and as and when, just like Samirji said, there are two angel funds which are already up and running. More will definitely come into IFSCA once the compliance requirement, one-time registration requirements, KYC requirements, if at all there is any, been highlighted by the IFSC authorities. Our scope of service is, of course, be vigilant. Our responsibility is to ensure that we are vigilant in terms of doing what the authorities are what the fund is doing, checking all the documents, operational activities, acting as a watchdog. That's how this trustee works, and getting information on time. And if there is any relevant compliance is missed by the FME and the trust, we ensure that it is done on time. That's about it from my side. Over to you, Samirji. I'll leave it to you now.
Thank you, Venkatesh. Thank you. I think you are being a trustee to so many funds, and huge amount of information and insight you have. So I think you can unshare your screen, Venkatesh, now.
Yes, yes.
So as far as angel fund is concerned, one thing I would also like to mention to the participants, कि when an angel fund invest in any startup or a company, you have to file your intimation to the IFSC within 10 days of that investment. And with every intimation, you have to pay $500.
Correct.
Which is not with SEBI, where in SEBI you don't pay any fee on intimation, but in IFSC you have to pay $500 along with every intimation. So that you have to see. So now if somebody is making investment in tranches, then what you do, then there will question arise whether every tranche I have to pay $500, how it has to be done, and all those things. So it is again as things are to be evolved, but for our client, they are sending in tranches. We are intimating after the tranches have gone, and we will give one intimation after all the tranches are gone, because the regulation says intimate after the total investment. So total investment will be after my all tranches. So we intimate. So we don't pay for each tranche, we pay for the total investment. So that's what interpretation we are taking and we are going. So coming to Ishan on taxation, so there are some questions on FME. So when you say FME, so when FME, now there are FME in the GIFT City where the fund managers are angel funds, and they, they have global members to their network, and they are charging membership fee to these. So if the FME is charging consulting fee or a membership fee to any other fee to the global investors, then how it is taxed?
Shankari, you want to take it? I think it's not subject to tax there, but yeah, go ahead, Shankari.
Yeah, any income from the gift fund is not subject to tax, so that will
No,
not be.
this amount would not be from gift fund. It would be direct payment by the investors to the FME.
But that's earned in the gift fund, the fund
Yeah.
operating from the gift fund. So that
But it would come in the account of the FME directly. by
FME,
the-
which is operating in from a gift fund.
Yeah,
So
yeah.
that's why it is not taxable.
So the nitty-gritty there is the entity collecting the membership fee must operate from within GIFT City. Now,
Gift City.
that entity can be a branch, it can be a subsidiary. There are ways to set up that entity in GIFT City. Once the entity is set up there, the fee that it collects, either by way of membership fee or by management fee or any other income streams, will all be exempt from tax when they do the 10 to 15 year, the 10-year exemption window out of the 15-year consecutive period.
So one more question. If the FME is formed as an LLP, then at the year end, like there is no taxation of FME, and the profit is distributed to the partners. At the end of the day, whatever is the book, that it is amount distributed to the partners. So the partners are residing in India. So the question is whether partner will also get taxed, or it is free for partner.
It will be tax-free for the partners. the LLP is the subject matter entity subject to tax. It is not been taxed on its profits. Anything distributed post-tax, in our case being nil, two partners of the LLP will again not be taxed in their hands.
One more question, whether the fund in GIFT City, when is distributing the money to the contributors or the investors, would it deduct TDS?
Yes, it will deduct TDS. TDS at the rate of 10% plus little bit surcharge in cess will be deducted at the time of distribution on the amount of gain that the fund has made pursuant to that investment.
So, Venkatesh, there is a question whether registration from SEBI, such as FPI or FBCI, is required for investment by IFSC fund, finance company in the share of finance company, insurance finance company in the shares of an Indian company, listed or unlisted.
Okay, so whether registration for SEBI such as FPA or FEC is required for investment by IFSC fund, financial company in the share of an Indian company. No, I don't think so, because here there is no SEBI requirement as such. Okay, so it's a FME fund which is registered in IFSC. So no such requirement is there.
There is one more question. If invested via GIFT City in AIFs, for NRIs, remittance of exit proceeds will be permitted without FCGPR filing or not?
So investment made by a gift fund into the Indian companies, that will be considered as a FPI. So the Indian companies need to file FCGPR for the investment made by gift fund. So at the time of exit, again, it will be an FCTRS in case of transfer that needs to be filed. But the moment money is received by the gift fund, any subsequent distribution by the gift fund, no RBI filing needs to be done.
So somebody has put a question, what are the advantages of setting up GIFT City rather than opening outside? I think one of the advantages we just mentioned, we are talking about, is the tax benefits for a period of 10 years over a block of 15 years. And one of the major thing is the operational cost of a fund in GIFT City is far more cheaper as you do in Singapore or Dubai or any other place. Because if you do in Singapore or Dubai or Cayman Island or Jersey or anywhere, the representational cost, the people you hire over there is too much. So we are advising a client who they were making around 100 million pound fund. So just on FME level, fund manager level, they were saving 20 crores. So that kind of operational difference is there. So obviously this is one of the greatest fund over there, benefit. There is, can you throw some light on what major advantages we are getting versus incorporating outside GIFT City? So anybody, Venkatesh or Ishank, so can you throw some light on what major advantages we are getting versus incorporating outside GIFT City? Outside GIFT City may be in India or outside India. So I think we discussed just the same.
Yes, I think Samirji, you mentioned most of it. A, cost advantage, B, proximity, access to regulator. Samirji and Venkatesh will tell you that the regulator itself is very approachable, present within GIFT City, and therefore at an early stage when regulations are evolving, they are supportive enough to understand, accommodate, and bring out changes in a fast manner. So that is the second thing. Third thing is the entire PAN obligation requirement. So any investments happening directly into Indian AIFs required PAN, because all of your investors would have to be onboarded there, and therefore led to setting up of feeder vehicles outside India, typical to Indian AIF structures, and they would pool money offshore and then try to bring it to India because nobody wanted to deal with the Indian regulatory system in a direct manner. Through setting it up in GIFT City, again, that problem is solved. You don't have the entire issue of taking PAN or filing returns of income, and tax credits are available. So I think a lot of benefits plus all the subsidies attached make it a lucrative destination to explore.
So Venkatesh, there is a question, you can take it up. So on both the legs of investment, SEBI regulations would not be applicable. One, overseas to IFSC, and two, IFSC to India. Can you please confirm?
usually if IFSCA, FME or trust is registering or rather investing in an Indian entity or listed entity, FPI license is definitely required. Okay. If it's a non-resident or non-listed entity, then there is no such license required. But yes, FPI license is required if you are investing in a listed entity in India by the FME. So maybe Ishank, you can correct me if there is any disconnect from my side.
No, that's right. That's right.
Go ahead. Yep.
So I think with this, Ishant, one more thing, that TCS, I think you mentioned in that the TCS, which is collected at a 20%, I think it is from the even you spend 1 rupee or above 7 lakh,
It is above 7 lakhs. And
above
this-
7 lakh.
Above 7 lakhs, and this 7 lakh is an overall limit under LRS, which means if they have used for anything else, any other remittance purposes, and then limit will still be considered. It is not only for investment into gift.
And this 20 lakh you get when you file your income tax return in India.
Yes.
So, Malab,
against-
this 20% you can again get benefit.
Yes.
claim
Yes. Claim it against your tax liability.
It's similar like an advanced tax. It's called TCS, but it is an advanced tax.
Okay. And how the carry amount which the FME is getting from the fund would be taxed?
Okay, so again, if the now there is very detailed structuring happening around this, and again it will come with some caveats and riders from our end. Typically, if this income which is exempt is business income at the fund manager entity level. So in India, it was very common to have the carry structured as capital gains in nature, and it was pushed back through the units, and therefore enjoyed a lower capital gains tax treatment. Now in IFSCA, if this carry is being treated as business income and being earned by the FME entity, there is a position being taken that that carry income is also exempt from tax out of the 10 and 15-year window. But if this income is in the nature of capital gain income, then it is not subject to that sort of exemption. So this is it therefore goes into trying to understand, if you have two funds as a general license operator, do you sort of give equal income treatment in terms of recognition of nature of income to both your funds, or because you are enjoying a tax exemption, you treat it as business income in a GIFT City fund, but you consider it as capital gain income in your domestic fund, right? So a lot of, I would say precaution are being taken. The simpler method that everybody is following is treating as business income because it gives them the tax holiday. And that's like the upfront answer, but it has little bit of caveats attached, and you should be careful ultimately.
Means that if an FME is getting the amount without holding any unit, so there cannot be capital gain tax. So if that amount is coming, that would definitely come to their business
income. So especially normally how that is also structured is through sponsor units typically. And you also have within AIF the option to waive sponsor obligation altogether. So now you have a fund where there is no obligation of the sponsor or no IM money, but you're still earning returns. That would typically be business income by default.
So before we end, last question for Venkatesh, somebody has put on FIF, that investment in FIF by Indian company is considered as ODI or OPI. But this is not related to this session, but it is, you get, before we go on this, Indian company, only single family individuals can invest in FIF, or a company controlled, 90% controlled by them can invest in FIF. So now the question is whether it is ODI or OPI. Venkatesh.
So, it's a very difficult question to answer because there are a lot of things which is lingering around. So it may be considered as an ODI as on date, but still there is no automatic route as on date because of a lot of things. We can consider it as an ODI right now.
So there is one more question. Are FMEs obliged to report to offshore investor any tax obligation that arises due to change in regulation or tax law?
To any offshore report to offshore investors, the question is any tax
are FME obliged to report to offshore investors any tax obligation that arises due to change in? I think that is mentioned in the PPM that whatever is there. What do you say?
Yes, the answer would be yes. If an investor invested thinking the capital gains tax rate was 20%, tomorrow if the government changes the law and says, okay, going forward, all investments will be taxed at 15%, for example, then yes, we would be intimating the unit holders or our investors that the tax on your investment has now revised to this effect. So, yeah, I think yes, answer to that question is yes, we will intimate.
So I think thank you, Ishank and Venkatesh. We are 15 minutes over our time, and last time also we did a webinar on FIF. We were 45 minutes above the webinar. The topic is so interesting, and everybody wants to know more about it. And thank you, friends. Thank you, Venkatesh. Thank you, Ishank. Thank you, Venkatesh. Thank you, BJJ team. I'm just missing your name, but. It was really excellent to have all of you here and a nice session, and we keep on doing these webinars for disseminating the information about the funds and the GIFT City in India. Thank you very much. Thank you all.
Thank you, Samoji. Thank you,
Thank
Ishan.
you.
Thank you, Sanjay. Thank you, thank you. Thank you, everyone.
Best place for the lawyers to work in and set up standards for the lawyers to develop their skills being in this law firm. We aim to provide high standard of international legal services to our international, global and domestic clients.
India Juris is having innovative strategies with regard to intellectual property rights disputes as well as international dispute resolution. And we are having a lot of milestones which we have achieved and about to achieve.
At India Juris, as a full-fledged law firm, we are advising corporates, startups for their advice on IPOs and further transactional matters.
As India Juris, we aim to be the best place for the lawyers to work in and set up standards for the lawyers to develop their skills being in this law firm. We aim to provide high standard of international legal services to our international, global and domestic clients.
India Juris is having innovative strategies with regard to intellectual property rights disputes as well as international dispute resolution. And we are having a lot of milestones which we have achieved and about to achieve.
At India Juris, as a full-fledged law firm, we are advising corporates, startups for their advice on IPOs and further transactional matters.